The World Gold Council released its Gold Demand Trends Report on Thursday, as the report found demand for the second quarter of this year hit 856.3 tons. Chatting with us today from London is Marcus Grubb. He's the Managing Director of Investment at the World Gold Council. Marcus, it's great to have you back with us. Global demand dropped 12% from the same quarter a year ago, and your report says ETF outflows were a major factor in the decline. Why?
Yes, we saw an outflow of 402 tons on the quarter in ETFs, and effectively this is a story of the rest of the market taking up this flow of gold that came back in as a result of the redemptions in ETF products. On the other side of the equation, we saw most other categories of demand up significantly on last year. Consumer demand was up about 58%. We had jewelry demand up 37% globally. Bar and coin demand was up over 70% to a new high of 507 tons. So
right.
I think it's a perfect example of a quarter where you had gold coming out of investors' hands in the ETFs, but heading eastwards into bar and coin investment and jewelry in India, China, and elsewhere.
Yeah, so let's explore that a little more. Like you said, jewelry demand up 37%, physical bar demand up 75%, official coin demand up 92%. Can you explain to people who aren't so familiar with paper markets versus the physical market, what exactly happens in this type of situation where you see ETF outflows but surge in demand on the consumer side?
Yes, well, it's worth casting your mind back to the quarter in terms of price action. We had a big drop in the price in April as a result of some trades that went through the futures exchange, COMEX, in New York. And that forced gold well below its equilibrium price in mid-April. Now, of course, that was linked to sentiment changing on the US economy, on some investors coming out of the ETFs because of a belief that the US economy was gathering pace, that the Fed would taper monetary policy and quantitative easing. But on the other hand, around the world, that forced the gold price lower and below, I think, a perceived equilibrium or fair value price for many consumers. So as a result, in this set of quarterly figures, you see strength all over the world, in India, in China, in the Middle East, in jewelry, even in the US, you saw jewelry print a further rise in tonnage, 2% up for the first time since 2005.
Sure.
And then bars and coins, the same story. So I think a lot of this was really a reaction to the drop in price. Gold was perceived as cheap by many investors and consumers outside the United States,
right,
outside the ETFs. And you have the tonnage from the ETFs heading into other hands in China and India and elsewhere.
Sure. So in central bank action, we actually saw a 57% drop against the same time a year ago. Central banks, for the past many years since the financial crisis, have been known for snatching up gold. Why are we seeing a slowdown there?
Yeah, so it's a good question because they came in at the lower end of what we were expecting. Still a positive quarter, though. I think it's worth saying that. It's the 10th quarter in succession. It's still at record levels since the 1960s. But you're right in saying that, we would have expected perhaps to see more central bank buying in this quarter than the plus 71 tons that we saw. And the big buyer was Russia in this quarter, a 15-ton purchase. I think, though, on the one hand, central banks do time purchases, so they do look for drops in the gold price. But equally, if there's a perception that the price is not yet stable or may drop further, then central banks and others won't necessarily come in and buy. And I think casting our minds back to Q2, because remember these numbers are back in the second quarter of this year, I think there was still a lot of uncertainty then about the direction of the market. And to my mind, that may be the reason why you didn't see a higher amount of central bank purchasing.
Sure.
Looking forward, I think if the price remains stable as it is, and it's even starting to move up a bit again now, we do think you're going to see continued central bank buying, and it may even re-accelerate again. So fundamentally, we don't think that story's changed. We just think this was a very volatile quarter.
Right, Marcus. So looking ahead into the final two quarters of this year, do you see the paper side still bringing down demand despite a surge in physical demand, in India and China?
Well, I think it's worth bringing in the third element here as well. I mean, I think that whilst it's the tonnage in ETFs that's come back into the market in terms of physical bars, the real driver for all of this action has been the futures market, because you've seen the positioning on COMEX go much more bearish this year than ever before in the last 13 years since the bull market began. The net long has declined in futures on gold from about 20 million ounces in December to about 2. Now, in the last week, that net long has gone back up to 7 million ounces. What that means is that in the futures market, a lot of the bears who were shorting gold have closed out those shorts in the last week and taken their money out of the market. That's the first good sign we've seen since January, really.
Yeah.
I think the second sign is that if you look at the redemptions in ETFs, in the physical ETFs, that has slowed down tremendously from this quarter. And, we've got figures already for the next quarter after this one for ETFs. We're probably going to see a 50% plus drop in the rate of redemption when you come into Q3. And in recent days, it's slowed to a trickle. So our view on the ETFs is that much of the money that went in over the Lehman bankruptcy and concern about the financial system collapsing, that 650 tons has now come out of the physical ETFs, and we think they're going to be a lot more stable from here.
All right, Marcus Grubb from London, thank you so much.
Thank you.
For The Street, I'm Joe Deaux.